Welcome back to Everything Money. In this video, we will talk about advanced micro devices, AMD. We'll go over the financials and do a fundamental analysis using our software. We'll show you the numbers. We'll tell you what we're paying for AMD moving forward using our stock analyzer tool. And if you want to trade this company, Mo will show you all the charts and trends for a short-term or long-term trade. But first, why should you watch this video? We will talk about AMD, its competitors. I will bring your questions about AMD to a couple guys who own and operate over $100 million in real estate all over the world, multiple businesses and stocks, and they'll give us a mindset about investing in an awesome company like this. Paul, tell us what the story is on AMD.
Thank you, Seth. Please follow us on Instagram, Everything Money Investing, for our new Instagram account. And follow us personally so that whatever witty line I'm going to use that I overuse. Okay, so let's go to the Everything Money software, our 8 pillars tools. We're going to type in AMD, advanced micro devices. Let's look at this chart, baby. This is the max chart of AMD. So I remember these times. This was tech time. And then it was AMD is going to pass up Intel, and now it's on this huge run up for the same reasons back here. So, guys, parabolic rises, forget about valuations, just parabolic rises have a hard time staying up there. Mo will talk about that more in his charts, but parabolic rises are so hard. But we're going to look at this and compare it to Intel. So I'm actually going to open a separate window up and go to Intel. I'm going to pull up Intel. So, guys, Intel is a $200 billion company with $78 billion in revenue. AMD is a $180 billion company with $15 billion in revenue.
Big diff.
So 10% less market cap, 1/5 the revenue. 80% less revenue. Okay. Net income, $4 billion. Intel's net income, $21 billion. Awkward. First pillar, we want the 5-year PE to be under 22.5. 5-year PE, 171. That's an X, massive X. Pillar number 2, the return on invested capital, we want to be over 9% on a 5-year basis. It is 9.5%, check mark, which means they get a pretty good return on the capital that's invested in their business through debt and equity. All right, no dividend. Average 5-year free cash flow is $700 million, and last year was $3 billion. So a massive increase in the free cash flow in the last year. All right, pillar number 3.
Revenue growth over the past 5 years.
We go to our income statement, our exclusive software. 5 years ago, $5 billion. This year, 14.85.
Pretty
massive
good.
check mark there with a huge jump in the last year. All right. Pillar number 4 is net income growth. We had a loss of $66 million to a gain of $4 billion. Check mark there. That's a huge jump. The previous year, they did $880 million. So even their 5-year PE of like 100 and some, is factoring in the massive jump in the last year. Do you see this, Seth? They made more in the last year than they made in all of... Wait a second. They made more last year than they probably made in their history. Let's look at that. Yeah, for sure. Because they had some big losses along the way. Yeah, that's incredible. All right, pillar number 5. Guys, shares outstanding. This is the silent killer on investing. We don't want them. Now, granted, this company's overpriced, so I'm hoping they're issuing shares versus issuing debt. But overall, we still want, you got to remember, as they issue shares, they are diluting you as an owner. If you own 10% of the business, because you have 10 shares out of 100, and they increase those shares to 150, you still own 10 shares, but now you only own 6.6% of the business because you own 10 out of 150 shares. So 5 years ago, they had 957 million shares. Now they have 1.2 billion. They are diluting the crap out of their owners. Understood, though, because they're expensive, and they're the local crack dealer in the corner trying to sell those shares out to the people who want it. So I understand that. Pillar number 6 involves debt, guys. Now, the way we do this is, the reason we look at debt is we want to make sure that the company can survive bad times. It's not about stock market crashes, it's about recessions and a slowdown in demand or things within the company that make them want to pause a little bit and they have to get through. So we look at we go back to the main page of our software. We go to the 5-year average free cash flow. We multiply it by 5. That is roughly $3.4 billion. Okay? So then we go to the balance sheet on our trustee software. We scroll all the way to the bottom.
Total long-term liabilities?
Only $450 million. They can easily support this. Jeez. Massive check. They have very little debt. That's awesome. So the likelihood of these guys going under is probably very, very unlikely because they can pay off Just based on their 5-year average free cash flow, they can pay off their debt in a matter of 8 or 9 months. That's incredible. That's awesome. Okay.
Pillar number 7, the grandpappy of them all.
So guys, free cash flow. We're going to go to the cash flow statement on our software. And free cash flow is cash from operations less your capital expenditures. You can do 5 things with that. You can buy back shares, pay dividends, make acquisitions, pay down debt, and reinvest back in yourself. This is the lifeblood of a company. It's more important than earnings because it's actually the cash in versus cash out of the business. So on our software, we have cash from operations less your capital expenditures, and we add this extra line here to make the math easy for you. That way you don't have to sit there and use your calculator like Seth used to have to.
Yes, terrible.
5 years ago, they did a loss of $223 million. This year, they had a gain of $3 billion, massive check mark. And for our final pillar, this is the most controversial one, but it shouldn't be. Just like a PE, we take the 5-year average free cash flow, we multiply it by 20 for a starting point on value. The market cap was $180 billion. So we want this 5-year average free cash flow times 20 to be under that, to be over that, sorry. So 700 million times 20 is 14 billion versus the $180 billion market cap.
Oh, it's that far off.
That far off. Massive X, guys. Now, does this in and of itself mean don't buy it? No.
Come on.
If it's a fast-growing company with a lot of potential, it can get into that value. But we're currently talking about like 13 or 14 times greater value in the company than justifies the cash flow. Is that really what we want to be doing? I don't know. So this is the 8 pillars tool. Biggest issues we have here? Value. 260 times free cash flow. Granted, the shares outstanding is terrible too. And the problem with the shares outstanding is if they increase their shares by 50%, and they increase the profit and revenue by 50%, guess what gain you got?
Zippity-doo-dah.
0. Think about that. If the company has $10 in profit and 10 shares, that's $1 per share. If they increase their profit by 50%, it goes to $15 per in profit. But let's say they also increase their shares by 50%, you're still at $1 per share. So you saw the company increase by 50% in its profit, and you saw nothing of it. That's the problem with dilution. So when they're diluting us by 30, 40%, they have to do above and beyond that 30, 40% growth to even justify that. So for those of you who just look at it and go, they're growing like crazy. Yeah, but they're also growing their share count like crazy. Now, we're going to use a stock analyzer tool. This is, and I'm going to use dark mode because it's easier to look at on our software. This is the most important aspect of our software that people have loved. It allows people to make an assumption about the future because every investment is the present value of all future cash flow, right, Seth?
Mm-hmm.
So our goal is to make assumptions because we don't know what's going to happen in the future. You make low, middle, and high assumptions, and it gives you a range of what prices you should pay for the company based on those assumptions. It's just math, guys. That's all it is. Every investment's just math. Your assumptions are what are going to factor in that math. So first assumption, I'm putting in 10 years of analysis. First actual assumption is revenue growth. Guys, this is the lifeblood. This is why this is most important. You'll see other videos where people comment below and say, Paul doesn't care about revenue growth. Yes, I do. I just don't overpay for revenue growth. That's it. There's a big difference, right? Just like Ferrari is the best car company in the world by some people. Fine, pay $1 billion for one Ferrari car.
Too much.
No, it's not. It's the best car in the world.
Right.
It's important. No, there's still such a thing as overpaying for a good thing. And that's what makes a value investor different than somebody stupid. A value investor says, that's great, but how much? I still love it. You know, my assistant will come and reach out to me and say, Paul, this person wants to sell you this. Are you interested in buying it? Well, how much? Oh, I didn't find out. Why waste my time?
Yeah.
If you tell me $1, it's buy it all day. If you tell me $10 million, I'm not going to buy it. You know what I mean? Like these things like that. So anyways, so Mo, AMD has a lot of revenue growth potential, right? Because they are taking away market share from Intel.
Yeah.
What have you found in your research on AMD?
So they're getting into this omniverse, or not a metaverse. So that's good. Let's see what else we have.
Well, it's only good because we all hear that it's good. Because everybody else is doing it suddenly.
That's a very good point. Touche. Oh, let's see here. AMD is moving toward, they're also getting into Wi-Fi 6E. I think that's so there was Wi-Fi 5, and then there was Wi-Fi 6, and now Wi-Fi 6E is coming out. So this is going to be the new fastest Wi-Fi that works with fiber. That's a really good thing. Let's see. Their revenue has increased 54% year over year. So, Paul, I'm going back and looking at their income statement. Let's take out 2020 and 2021.
Okay.
It's just didn't really go. I mean, it grew inconsistently in that time period. That's why I'm just very hesitant to go. What's your revenue number?
The last
here?
2 years was such a fluke.
That's the thing that I'm looking for. But now the good thing was it was organic. There was no acquisitions in there. So
let's be aggressive with AMD. I want to show people how ridiculous this company is overpriced. Go insane.
12, 15, 18.
That's not insane,
Love it.
is it? Oh, that's
No, it's not insane, but it's a higher number than it did in the last 10 years.
Yeah.
Okay. Profit margin.
You want me to go crazy on this too?
No, I would be more like Intel. I think Intel's is like 20% or 25%.
Profit margin?
Yeah.
Then make 25 the middle number.
Okay, 22, 25, 28.
Okay.
That's going higher than they have done in any. Right?
Oh, yeah.
So, okay.
Oh, yeah.
Free cash flow margin. Let's do the same thing.
Same thing.
PE.
18, 20, 22.
I love it. 18, 20, 22. And then always, guys, I always do a return of 12.5%. The more risk involved in the company, the higher that should be, because it should be your margin of safety, essentially. The higher the return you want, the less you pay, right? That just makes sense. The less you pay for something, the more return you make. Hit the analyze button. The stock's at 148. Okay, on the very, very high end, it hits it.
164?
164.
How did we get even close with this thing?
So if you think they're going to do a profit margin that they've never done before.
So this assumes massive revenue growth in the next 10 years. It would take, so 18% a year. What did they do in revenue last year? 15 billion?
Yeah.
So that would take them to being bigger than Intel in 10 years.
That's fine. Okay.
Okay, so they're going to be bigger than Intel in 10 years. Just imagine how hard it'll be to be bigger than Intel, the number one. That would literally make Intel like collapse.
Well, Intel actually does 78.5 as
That's
well.
what I mean.
So,
78.5? Okay, so it's the size of Intel.
Yeah, size,
Thank you.
yeah.
I thought it was like 77 billion for Intel.
Okay, either way.
It would have a profit margin higher than they've ever done and higher than Intel's. It would take a free cash flow margin. Let me make sure it's higher.
Here's Intel right here. Oh, there you go.
I'm going to pull up stock analyzer tool. Yep. Higher than Intel's profit margin. Higher than Intel's free cash flow margin. All these things have to be better than Intel. They have to really wipe the floor with Intel. Completely wipe the floor with Intel. And it's still barely the right investment at this time.
Third decade's a charm.
Third decade's a charm. And I made really, really high assumptions. We did our revenue growth at 12, 15, 18. The last 10 years, it did 10. So even if the market is, even if the chip market is growing 4 or 5% a year, whatever, I don't know what the number is. You have to go research that. How much are they going to take up of it? Let's say it is 12, 15, 18. I'm still probably closer to the low teens than anything. It's probably somewhere really in this ballpark. And guys, you can't forget they're going to dilute the crap out of you at some point. They're going to dilute you. They're going to keep issuing shares as long as the crackheads are coming to the corner saying, please give me crack.
Yeah.
They're never going to stop doing that. So this has been very popular. That's what I love about our stock analyzer tool. It lets people really see how to value a company and make their assumptions and go forward.
If you're looking to get this software behind Paul, here is your chance. He'll tell you how to join our community and get it right now. Go ahead, Paul.
We were doing these on Excel, and our users wanted a way to look at their own companies and to be able to analyze their own deals without waiting for us to make videos on it. So we made the software. We invested hundreds of thousands. With the software, you get everything you saw here. You get it all on your iOS or Android device, either one. You get everything on there. Get the stock analyzer tool. You get all of these tools right here, plus all the ones that are coming. There's more adding. We're adding news. We have exclusive daily content, 2 or 3 videos a day from Seth Moe and I. You also get access to Seth Moe and I. You also get access to our community. There's over 6,000 people who currently subscribe to the software. They're in a group, in a big chat with lots of different rooms discussing tons of topics, including crypto and Tesla and other hype stocks you guys might love. There's trading. There's Mo with the trading. You get all of this for only 90 cents per day. 90 cents per day. If you're serious about your financial future, if you either save or increase your returns by 1 or 2% a year, or decrease your losses by 1 or 2% a year, it could lead to hundreds of thousands, if not millions of dollars in extra gains in the long run, and it's only 90 cents per day. 2 ways to sign up, everythingmoney.com or Patreon. Either one gets access within minutes. The benefit of everythingmoney.com is you don't pay sales tax yet because they're not large enough, so sign up now, only 90 cents per day.
community to trading this. What's up over there, Mo? What's going on?
So so let's just zoom out here. I'm going to zoom out. Oh, let's go 2 years. So with the exception of this little blip right here, this looks like this is a complete anomaly. What's happened in the past since summer, basically. That run up is just unreasonable. The reason I say that is, could it be warranted? Sure. Can it stay? Sure. But the likelihood of it staying is not. I'm creating these are what we call flagpole patterns. The stock price runs up and then it creates this flag and it kind of falls back down. And this has just been a crazy run up since October. I still think that this thing is going to come down to this 110 level. And we can see that volume is starting to slow on the stock. We're starting to get this little bit of rollover. If this red line starts to turn down into the sweet spot, that's where you can get your short. So I think that you should put this on a long-term short watch list. And when you start getting engulfing candlesticks coming down, when this starts rolling over, this is going to be a really good short for you because I think you'll get into that 110 area. Let's say you don't want to do that. Let's say you want more of the day-to-day. This is where you can come and make money on this company. You can come in here and grab these little swing trades and just run them up over a 5 or 6 day period. Even here, you get a good run up right here. There's a friend that I have. He trades 5 stocks. He runs stocks up and he runs stocks down, just the same stocks over and over and over. He doesn't deviate from those 5 stocks all year. Here we went through the sweet spot, and this is a really long trade. You were in it, and you could have stayed in this thing until basically earnings, and you sell as soon as that red line drops below yellow. Another way to do this is on a day trading chart because it has a high beta, meaning it has a lot of volatility. So if you want to learn these rules, come and join me in the BitNAS Nation. You'll get access to my rules through the Trading 101 series. You get the Employed Traders series, which is long-term, 6 stocks that we go through every single day and I teach you about if you are a working person and don't have time. We get the Discord community of 900 people, and you get my monthly seminars, which is just random Q&A in addition to my teachings. And it's a great place to be. If you want to learn to trade, come and join me.
We are not offering or selling some secret membership or formula. There are no tricks. It's just guidance and sticking to rules and a mindset of being disciplined when you're making either a long-term trade or trade with Mo. So that's our take on AMD. Fondle a thumbs up, tickle the thumbs up, and we'll see you next video.